Well, the stock market's taken a bit of a turn for the worse this past week, isn't it? Hey everyone, Daniel here, and welcome to Next Level Life, a channel where you can learn all about investing, debt, retirement, and many other general financial education videos besides, because let's face it, the schools aren't going to teach it for us. So if any of those topics sound interesting to you, or if you want to learn how to better handle your money and have more financial freedom, be sure to hit that subscribe button and the bell next to my name to be notified every time I upload a new video. Well, I didn't initially plan to do this video this week, but seeing as the market kind of took a bit of a tumble at the end of last week, losing about 5% of its value according to the S&P 500 in the last couple of days, I figured it's probably a good time to upload this video. So it's March 25th, 2018 as I'm recording the audio for this video, and from March 21st to March 23rd, the market dropped from about $2,720 all the way down to about $2,590, which again was a loss of about 5% in the span of 2 days. And with things like possible trade wars being all over the news lately, one has to wonder, is the market about to experience a correction? Well, as I mentioned many times on this channel before, and as I will continue to mention many more times as we go along, I have no idea whatsoever what the market's going to do next. Nobody truly does. But if the market does crash, I thought it'd be a good idea to take a look now, before it happens, and see, during a market crash, how much of a difference can you make in your net worth by continuing to invest when everything's going downhill. So in this video, I'm going to be giving you a bit of a crash course in the stock market crashes and go through the most notable market crashes since the 1950s using data from the S&P 500 as a barometer and talk about how much the market actually dropped as well as how long it took the market to recover. Then at the end of the video, I'm going to compare and contrast the differences in net worth between someone who pulled out during large market crashes and someone who decided to stop investing during the crashes but didn't sell off the investments they already had, as well as someone who continues to invest like normal during large crashes, and just for the fun of it, also someone who starts to invest even more when the market is going down. Let's get started. Alright, one last thing I do want to mention before I actually get into the crashes themselves is that I do understand that crashes can be very bad in more ways than just seeing your investment values going down. The unfortunate fact of the matter is that a lot of people lose their jobs when the market crashes. So all this stuff that I go through in today's video is going to be valid only if you can keep an income coming into the household during the crash. But it's still good to know. So, getting to the crashes. In December of 1952, the S&P 500 peaked at $26.57. Over the next several months, it dropped to a low of $23.32 in August of 1953. That was a drop of a little over 12%, and a few months later it would recover and break its original peak of $26.57, closing at $26.94 in March of 1954, meaning that it took about a year and 3 months for the market to go from its first peak all the way down to the point where the market fully recovered and set a new all-time high. In July of 1956, the market peaked at $49.39, before dropping down to a low of $39.99 in December of 1957. So a bit of a longer drop that time, and it ended up being 19% when all was said and done. A few months later, it would again break its original peak, closing at $50.06 in September of 1958. So this drop was a little bit longer. 2 years and 2 months is how long it took for the market to go from its original peak all the way back to the point where it breaks its old peak and sets a new high. Then, in July of 1959, the S&P 500 peaked at $60.51 before dropping to a low of $53.39 in October of 1960. This was another 12% drop. Just a few months later, it would again close at a new high of $61.78, and that was in January of 1961. So about a year and a half is how long it took from the market to go from its peak to its low and back to a new peak. The rest of 1961 played out pretty darn well, but in December of 1961, the market would hit its peak of $71.55 before dropping to a low of $54.75 in June of 1962. This was a much bigger drop than the last one and ended up being a little bit over 23% when all was said and done. And the market would not recover until August of 1963, where it closed at a new high of $72.50. So once again, we have somewhere in between that 1 and 2 year time span where the market goes from its old peak down to its low, back to its new peak. This time it was a year and 8 months to be exact. In January of 1966, the S&P 500 peaked at $92.88, and over the next several months it dropped to a low of $76.56 in September of 1966. That drop was a little bit over 17%, but it would of course again recover in April of 1967 when it closed at $94.01. So it was a bit of a shorter time span this time around, just a year and 3 months to go from peak to low back to peak. In November of 1968, the S&P finally broke $100 and peaked at 108.37 before dropping to a low of 72.72 in June of 1970. This was a pretty darn big drop, and it ended up being just under 33% when all was said and done. And the market would not truly recover until May of 1972 when it closed at $109.53. So this was the longest crash yet. It took 3 years and 6 months for the market to go from first peak all the way to the point where it fully recovered and set its new high. And people, the 70s were not the best time for the market, because in December of 1972, the S&P 500 peaked at $118.05, but would drop all the way down to $63.54 in September of 1974. So it took the market nearly 2 years just to go from its peak down to its low, and the drop was about 46%. And the market would not recover to set a new high until July of 1980. When it closed at $121.67, meaning that this drop, coming right after the last one, which was already the worst we had seen since the 50s, took 7 years and 7 months to go from first peak all the way to the point where it fully recovered and set a new high. Does that sound familiar to anyone? However, the early 80s did come back to normal. In March of 1981, the S&P 500 did peak at about $136 before dropping to a low of 107.09 in July of 1982. This was a decent drop, but not quite as big as the last two, ending up being a little over 21% when all was said and done. And the market would recover to set a new high in November of 1982 when it closed at $138.53, meaning that it took about a year and 8 months for the market to go down and then come back. But then of course the late 80s had another crash. In August of 1987, the market peaked at $329.80 before dropping all the way down to $230.30 in November of 1987, so a very quick, sharp drop from August to November. When all was said and done, the market crashed over 30%. And it would not truly recover until July of 1989 when it closed at $346.08. Meaning it took a year and 11 months, or basically 2 years, for the market to go from its first peak down to its low, then all the way back to set a new high. In May of 1990, the S&P 500 peaked at $361.23 before dropping to a low of $304 even in October of 1990. That was a drop of a little under 16%. More of a hiccup than anything at that point compared to the earlier drops. And it would recover to close at a new high of $367.07 in February of 1991. Then of course we had the roaring 90s as the dot-com bubble continued to grow bigger and bigger. The market did really well all the way up until about August of 2000, where it peaked at $1,517.68 before dropping all the way down to $815.28 in September of 2002. That was another 46% drop. And the market would not recover to set a new high until September of 2007, where it closed at $1,526.75, meaning that it took 7 years and 1 month for the market to go from its peak to its low back to a new peak. And of course, right after setting that new peak, we had the housing crisis. In October of 2007, the S&P 500 peaked at $1,549.38 before dropping all the way down to $735.09 in February of 2009. That was the biggest drop since the 50s if you look at the percentages anyway, and it ended up being a little over 52%. And it would take the market a while to recover, though not quite as long as it did for the dot-com bubble. In March of 2013, it did set a new high of $1,569.19, meaning that it was 5 years and 5 months for the market to go through the cycle. And then after that, for the most part, the market has been doing pretty darn good. We did have a little bit of a hiccup in May of 2015 when the market peaked at $2,107.39 before dropping to $1,920.03 in September of 2015. But that was about a 9% drop, not nearly the same as the last two we had experienced. And it would recover pretty darn quickly, because in July of 2016 it closed at a new high of $2,173.60. So a little over a year to go through the cycle that time. And with that out of the way, now that we've got a bit of a crash course in the crashes of the market since the 1950s, let's get on to the comparison that I promised. Now, obviously, people aren't going to be working for 70 years, or at least most people won't. The human body just can't really sustain it. So I won't be using the data from 1950 to today. Instead, I'm going to be using the data from January of 1978 to the end of December of 2017, so that 40-year period, to get a more realistic perspective. And in all 4 cases, I'm going to be assuming that they invested $100 a month of their own money. So let's see how their net worths change depending on how they handle market crashes. I'll start with Joe. Joe is a little bit more nervous during market crashes and tends to panic just a little bit more than he would like to admit, and as a result, he tends to sell his investments when the market is bottoming out. Now, is that just a little bit unrealistic to say that he would sell off his investments at the low point of the market every time? Yeah, I admit it is a little bit unrealistic, but this is just for an example to illustrate the differences in your net worth depending on how you handle market crashes. So Joe starts off in 1978 confidently investing $100 a month, and the market starts to go down, of course, in March of 1981, as I said earlier. It ends up getting so bad that he can't take it anymore. He loses his faith in the market, and in July of 1982, he completely sells out of the market. He of course regains his confidence in November of 1982 when the market sets a new high, and that's when he buys back in. Now remember, between March of 1981 and July of 1982, the market dropped about 21%. By the time the market hit its new low, Joe's net worth was $5,250. So that's what he got when he sold his stock, and that also, just for the sake of convenience, is what he puts in November of 1982. And this pattern continues with Joe throughout the rest of his working life. He continues to invest as the market begins to go down, but then panics when it hits its low, and he sells off his investments before getting back into the market after it sets its new high, at which point, of course, as I said, he reinvests everything he made from selling his stocks when the market was low. This means that over the course of 40 years, he puts over $178,000 into the market. Now that number does include the amount that he put in after selling his stocks, so it is a little bit misleading. If we were to just look at the amount of money he put in with his $100 a month investments, it would come out to be about $32,700 over the course of that 40 years. His total net worth at the end of 40 years? $46,014.16. Keep that number in mind as we move along. Now let's look at Betty. Betty is a little bit more confident in the market than Joe, but not quite confident enough to continue investing as it's going down. However, unlike Joe, she does not sell out of the market at any point. She will invest $100 a month just like Joe did until the market starts dropping. And once it starts dropping, she will stay invested but won't continue to put any more money into the market. Similar to Joe though, she will begin investing again once the market sets a new high. Over the same 40-year period as Joe, she will invest $26,800 of her own money into the market. A little bit less than Joe if you'll remember, and she winds up with a net worth of $258,449.67. Now, despite investing several $1,000s less than Joe, she has over 5 times as much as he did when she's getting ready to retire. About an extra $200,000 to her name. So clearly, at least over the last 40 years, it is much better to stay invested in the market, even if you don't quite have the confidence to continue contributing to your investments during market downturns. And I'm sure that we all knew that already, but it is nice to have numbers put to it. But we're not quite done yet. Next, let's take a look at Charlie. Charlie is fairly confident in the market's long-term potential, and he continues to invest $100 a month, every month, no matter what the market is doing at the time. This means that over the course of 40 years, he will have put in $48,000 of his own money into the market. And since he never stopped investing, nor did he ever sell off any of his investments, he will end up with a 40-year net worth of $370,424.37. Lastly, let's look at Jane. Jane has an unwavering faith in the stock market's long-term potential. And not only does she keep investing $100 a month, no matter what the market is doing, but when the market starts dropping, she actually doubles down and invests an extra $50 a month during the drop and continues to invest that extra $50 a month all the way until the market hits a new high. At that point, she goes back to investing just her regular $100 a month like everybody else. In doing this, Jane will end up with a net worth of $426,411.71. That is an extra $56,000 more than Charlie, it's nearly $170,000 more than Betty, and it's almost 10 times the amount that Joe ended up with over the same exact time period. Now, Jane did invest the most out of any of the four, mind you. She put in $58,600 of her own money into the market over the course of 40 years. But with that extra $10,500 that she invested in comparison to Charlie, she ended up with an extra $56,000 in her net worth, meaning that those extra $10,500 earned her roughly $5.28 per dollar invested. So it was money well spent. In case you're curious, I get the number by taking Jane's net worth minus Charlie's net worth and dividing that by the difference between Jane's $58,600 of investments and Charlie's $48,000 of investments. The ratio is about the same when you compare Jane's investments to Betty's investments, and running the same calculation, Jane earns about $14.69 per dollar invested when compared to Joe. So you can see how big of a difference changing the way you look at stock market crashes and corrections can make in your net worth over time. It can be a huge difference, even when you're just investing $100 a month. Imagine what the numbers would be like if you were investing more. However, as I said earlier in the video, crashes and market corrections are an opportunity as long as you can keep income coming into the house. But I do also want to say that just because you can noticeably increase your net worth by shoveling as much money as you can into the market when it's going down, that doesn't always mean you should. For example, if you're up to your eyeballs in debt, you may want to consider putting the money towards paying off that debt, especially during market crashes, because it lowers your month-to-month living expenses and therefore your risk of going totally under and living on the street real quickly if you do end up getting laid off temporarily because the company has to downsize during a market crash. Because again, the fact of the matter is, even if you're doing really good work at your company, sometimes they do have to downsize as the market falls, so you may end up being laid off temporarily, and that should always be taken into consideration. But as always, consult with a financial professional when making these decisions. But that'll do it for me today. Once again, if you enjoyed this video, be sure to subscribe and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Friday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.